Hey there, everyone. Welcome to Profi 2020 Dental CPAs. I'm Chris Sands, and today we're diving into another important topic that can help all doctors. Whether you're a seasoned practice owner or just starting out, there's something here for everyone. So grab your notebook and let's get started. Today, we're talking about a situation that no one likes to find themselves in, a surprise tax bill. Imagine this. You're a successful doctor like Dr. Smith who's been told by his CPA that his tax bill for April 15th is much larger than expected. How did this happen? Let's break down some of the possible reasons why Dr. Smith is facing this unpleasant surprise. First, Dr. Smith had an outstanding year in terms of collections and business profit, but with that success came higher tax liability, which he didn't fully account for. Second, Dr. Smith hasn't set aside enough tax money in a dedicated tax account for the profit distributions he makes to himself. This is a common mistake by many business owners. Third, there's a gap in his understanding of how to calculate the right amount of money that should go into his tax account. Dr. Smith also skipped having crucial mid-year and year-end tax planning sessions with his CPA. Without those, he missed the chance to project his tax liabilities and plan accordingly. Finally, Dr. Smith didn't make his quarterly estimated tax payments. This not only left him with a large lump sum tax bill at the end of the year, but also exposed him to penalties and underpayment and interest charges from the IRS. So, what can Dr. Smith do to ensure this never happens again? Let's look at some practical steps. First, Dr. Smith needs to have more frequent communication with his CPA advisor. By keeping a close eye on how the business is performing, he can adjust his tax planning throughout the year. If his practice is thriving, he'll need to set aside more money into his tax account and manage his cash flow more effectively. Next, for any distributions of profit, Dr. Smith should make it a habit to set aside 40% for taxes. This will help him avoid the majority shortfall when tax season comes around. We must follow the 40% tax rule. Let's look at a quick example. If you have $10,000 gross that you want to take out of the business 1 month, that represents our pre-tax portion. We have to set aside 40% according to the 40% tax rule and subtract $4,000 for taxes, leaving us with 60% or $6,000 after tax. But that's not reality. Everyone gets this example. It's simple math. In real life, what happens is something unexpected occurs, and you need $10,000 personally at home to take care of something. The example I like to give is one time I got a surprise that I had to replace my gutters. Okay, so I need $10,000 to replace the gutters. So that is my after-tax amount, which represents 60%. How do I figure out what my total distribution needs to be and what the amount of tax to set aside is? Well, I have to do some reverse math, some algebra. 10,000 represents 60%. We need to take 10,000, divide by 0.6, and that's going to give us the gross pre-tax amount. 10,000 divided by 0.6, you'll get $16,667. We then know that the difference between this and the after-tax amount represents the 40%, and I would have to set aside in my business tax account $6,667. Don't let this trip you up. Always learn the math forwards and backwards, knowing that anything that I want to buy personally with my personal after-tax dollars represents 60%. Take that amount, divide by 0.6 to get the gross amount that you have to generate out of your business, and withhold the difference, the 40% tax, to the tax account. As long as you stick to the 40% tax rule with every distribution of profit that you take, you will account for the vast majority of the taxable profit that you're using throughout the year. Dr. Smith should also schedule regular mid-year and year-end tax projection planning sessions with his CPA advisor. This will give him a clear estimate of his total projected tax liability and allow him to plan ahead. Finally, he must review and confirm that all quarterly tax payments are made on time. Do them out of your business account. This simple step can prevent large bills and penalties down the line. Every business owner should commit and lock in these dates on their calendar. By following these steps, Dr. Smith can avoid future tax surprises and stay focused on what matters most, providing excellent care for his patients. Thank you for watching. Subscribe to our channel. If you have any topics you'd like to hear about, please leave a comment below. Plan ahead, stay informed, and keep your practice financially healthy.